In today's video, we're going to be taking a look at Main Street Capital, ticker MAIN. This is the sixth video that's a part of my portfolio series where I'm doing an in-depth analysis of all 31 stocks currently in my own portfolio. If you're new to my channel, my primary focus is on income investing and also dividend growth investing with holdings that offer at least a 4% yield. As I'll say in every video in this series, this isn't done in any particular order, so just because this video is sixth in this series does not mean that this is my sixth favorite stock or my sixth largest holding. Also note that because I own all these holdings that I am biased towards them, so do your own research and come to your own conclusion before making any investment decision for yourself. Also, let me know if there's any improvements to this series I can make going forward. Feel free to check out the last video in this series, which was on Realty Income, ticker symbol O. So going into my Vanguard account, which is where I do all my dividend investing, as of the making of this video, I currently own 225.165 shares of Main Street Capital. This stock pays monthly dividends, with their last being for 23 cents per share. With the number of shares I own of Main Street Capital, I collect roughly $51.78 every single month in dividends from this stock. Main Street Capital is a business development company that provides one-stop capital solutions, which includes private debt and private equity capital to lower middle market companies and debt capital to middle market companies. Main Street's portfolio investments are typically made to support management buyouts, recapitalizations, growth financing, refinancing, and acquisitions of companies that operate in diverse sectors. They're an internally managed BDC and they had their IPO back in 2007, and today they have approximately $6.6 billion in capital under management. According to the Sovereign Wealth Fund Institute, they're currently the 8th largest BDC in the world. Out of all the business development companies out there, Main Street Capital has had one of the best track records in terms of long-term growth. That's growth in both share price and dividend increases. Up until recently, when interest rates started to increase, it was rare for a lot of BDCs to grow their dividend distributions. Most of them offered a relatively stable yield of around 8% and didn't really increase their dividends so much. The reason so many BDCs have been growing their dividends as of recently is because a lot of them invest in floating rate debt, which results in increased interest payments from their borrowers. But Main Street Capital's been able to grow their dividends for more than 15 years and counting. On top of that, their stock also pays monthly dividends, which has made it a great pick for fans of monthly income. You can see in their investor presentation that this stock has never cut its dividend in its entire history. They made it through the 2008 financial crisis and COVID without having to reduce their dividend once, which is a feat that very few BDCs have accomplished. They haven't grown their dividend every single calendar year, but it's still never been cut, which is great. Their stock also pays the occasional special dividend to shareholders, which is never predictable, but it's always appreciated as an added bonus. You can see their dividend payments have grown 109% since their IPO in 2007, and they've also paid $4.89 in special dividends since being launched. You can also see the share price for Main Street has also consistently grown over time. Again, this is a pretty rare thing for a BDC to experience. Most BDCs don't see nearly this much growth in their share price. They usually have a flatlining share price or a moderate amount of growth over time, but for Main Street, they've been one of the best growers in this sector since their IPO. As of the making of this video, their stock share price is currently up 164% since being launched. This growth has also translated into Main Street being a stock that consistently beats the S&P 500 over time. If we run it through a drip calculator, which calculates the total return for a stock with dividends being reinvested, we can see that Main has smashed the S&P 500. Since 2007, Main Street Capital's provided an average annual return of 15.84% a year, which is far superior to the S&P 500's average yearly return of 8.46% during that same time. A $10,000 investment back when Main first launched would now be worth almost $100,000 today. But of course it needs to be said that this is all past performance and there's no guarantee that this company is going to be able to provide these same amazing results going forward. Also, their stock offers a much lower dividend yield than average for a BDC. It currently yields 6.82% according to Google, but that's still a great amount, and considering that they've been able to grow it so much has been excellent. The key to this company's growth has been their ability to keep increasing their net asset value over the years. Most BDCs trade around their NAV, so they don't move much, but Main Street's NAV has seen a good amount of increases over the years. The downside to Main is that it almost always trades at a pretty sizable premium. In the last 5 years, the only time this stock traded at a discount was very briefly in March of 2020. But this does not mean that Main Street Capital is a stock that you should avoid. Main Street's almost always trading at a premium because the market's just willing to pay a higher price for Main Street's high quality. If it dips, then it is a good buying opportunity in my opinion, but just because you see a stock is trading at a premium doesn't always mean that you should wait until it's trading at a discount, because in Main's case, you might have to wait until the next stock market crash to invest. According to Main Street, their ability to grow their NAV relies on 3 distinct features of this company that make them unique. The first reason being their investment focus, which is in equity investments in lower middle market companies. Main Street does hold senior secured debt just like other BDCs, but they also prioritize more equity investments. Unlike senior secured debt, equity investments have a greater potential for growth, but at the same time, they are considered riskier investments. Most BDCs typically focus right around the middle market, but Main Street invests in the lower middle market. According to Main Street, companies in this stage don't have a lot of options when it comes to looking for additional capital to expand their businesses. The second way they can grow their NAV is through their asset management services. According to this company, their asset management business represents additional income diversification and the opportunity for greater shareholder returns. So they serve as an investment advisor to several third-party clients and they receive management fees and incentive fees. It's just another way for Main Street to generate revenue for this company. The final way they can grow their NAV at a much faster rate is by being internally managed. When it comes to BDCs and mortgage REITs, there's basically two kinds of company structures, which are internally managed and externally managed. Internally managed companies manage their own investments, whereas an externally managed company will hire an outside firm to manage their investments for them. An internally managed company has lower costs, which saves the BDC a lot of money that they can use for other purposes. I've talked about it a few times, but an MREIT by the name of Rhythm Capital decided to switch from being externally managed to internally managed about a year ago. The move, although it was expensive, did work out for them because they now save an estimated $60 to $65 million a year that would have gone to an outside firm managing their assets. Internally managed companies are also more incentivized to see their stock share prices grow. Salaries and bonuses for the management team is typically dependent on how well a BDC's NAV is performing if they're internally managed. So it's in Main Street Capital's interest to grow their NAV over time. Externally managed companies, on the other hand, typically charge a percentage of assets, and it is possible to grow a company's assets without actually growing a company's NAV. Companies that are externally managed are also not required to reveal how their management team is compensated and how much they're compensated. There can be good reasons to invest in externally managed companies. My favorite BDC is Ares Capital, and they're externally managed. But they say just in general, internally managed BDCs are usually better than externally managed BDCs. Main Street's portfolio is pretty well diversified across different sectors. As you can see, their largest sector only makes up 8% of their investment portfolio. They hold investments in a wide range of industries including software, healthcare, distributors, chemicals, and electrical equipment. They currently have 195 different investments across their lower middle market, private loan, and middle market portfolios. They do have 13 investments that are on non-accrual status, which is a lot higher than what you typically see for a BDC. But fortunately, they represent only 0.6% of their total investment portfolio at fair value and 3.2% at cost. So although it is a high number of non-accruals, it doesn't account for a huge position in their overall investment portfolio. According to FinViz, their insider ownership percentage for Main Street is around 4.1%. This is quite a bit higher compared to the other BDCs that I've come across. I'd say the average percentage from what I've seen is around 1 to 2%, so at over 4%, this is quite a bit higher. A high insider ownership percentage does indicate that the CEO and the management team is really confident about the performance of their stock. If the people who work for the company and know it the most intimately are willing to buy shares using their own money, then that's usually a good indicator that they have a lot of faith in their ability to grow their company. In summary, up to this point, Main Street's been an excellent choice for people who like both dividend growth investing and income investing. I definitely consider it to be one of the very best BDCs out there, and even if you're not a big fan of dividend investing, it's still a stock that's continued to beat the S&P 500. It's too bad there aren't too many Main Street Capitals out there, but like I said, this stock continues to be one of my favorites, and I consider it to be one of the cornerstones for a solid dividend portfolio. But with that being said, that's going to wrap up our look at Main Street Capital. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. You'll also have the option of reading this analysis as well as every other analysis that I do in this series. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.